Let me be straight with you right now. If you are collecting Social Security or you are planning to collect it in the next few years, what just happened on May 1st, 2026 is not something you can afford to ignore. This is not a minor update buried in a government press release. This is a structural shift in how Social Security works, how it calculates your benefit, how it adjusts for inflation, and how much money actually lands in your bank account every single month. And the devastating part? Most retirees have no idea any of this changed. They are going to wake up months from now, look at their statement, and wonder where their money went. Do not be that person. The next 14 minutes could save you thousands of dollars. Here is what is actually happening in homes all across America right now. People who have worked 40 years, paid into the system their entire lives, are sitting down at the kitchen table with a cup of coffee, assuming that their Social Security check is just going to keep coming the same way it always has. They are not reading the policy updates. They are not checking the Social Security Administration website. They trust the system, and that trust, unfortunately, is costing them money. The average retiree household is already stretched. Inflation has not been kind. Groceries, utilities, prescription costs, everything is up. And now, on top of all of that, a series of confirmed changes that took effect May 1st are quietly reshaping how much you receive, how it is taxed, and what you can do alongside it. The people who understand these changes are going to protect themselves. The people who do not are going to lose ground every single month going forward. I have spent the last several weeks going deep on every confirmed change, every policy adjustment, and every strategy that financial planners are quietly telling their high net worth clients right now. And I am giving it to you here, free, in plain English, because frankly, most retirees are not getting this from their advisors. A lot of advisors are not even up to date on this yet. What I am about to walk you through is real, it is current, and it is urgent. There are 4 core areas where these May 2026 changes are going to hit retirees hardest. And for each one, I am going to show you exactly what changed, what it means in real dollars, and what you need to do about it before these gaps compound into something much bigger. Let us start with the COLA adjustment recalibration, because this is the one that is going to blindside the most people. You probably heard that Social Security gets a cost of living adjustment every year based on inflation. In 2026, retirees received a 2.5% COLA increase. That sounds decent. That sounds like the government keeping up. But here is what most people do not realize. The inflation index used to calculate your COLA, called the CPIW, does not accurately reflect what retirees actually spend money on. The CPIW is based on urban wage earners and clerical workers, not on the spending patterns of people over 65. Retirees spend significantly more on healthcare and housing than working-age Americans, and those two categories have been inflating at rates far higher than 2.5%. Healthcare costs for seniors rose over 5% in the past 12 months. Housing costs, including utilities, are up nearly 6% year over year in many states. So when the government tells you that your benefit went up 2.5% to match inflation, what they are not telling you is that your real purchasing power is actually going down. The May 1st changes included a confirmed shift in how supplemental adjustments are reviewed, and the proposed CPIE index, which actually tracks elder spending, was once again delayed. This is where people lose money without ever seeing it leave their account. A retiree collecting $1,800 a month who assumed the 2.5% COLA was keeping them whole has actually lost roughly $54 to $90 in real purchasing power every single month, depending on where they live and what their healthcare costs look like. Over a year, that is more than $1,000 in invisible erosion. The fix here is not complicated, but it requires you to be proactive. You need to run your own inflation number. Sit down and actually track what you are spending on healthcare, groceries, and utilities versus what you were spending 18 months ago. If your real personal inflation rate is running at 4 or 5%, you need to account for that gap in your withdrawal strategy. If you have any savings, this is the time to talk to a fee-only financial planner, not a commission-based one, about inflation-adjusted withdrawal planning. Most people wait until the damage is already done. Now let us talk about the earnings limit change, because this one is going to affect a growing number of retirees who are still working part-time or thinking about going back to work. Here is the old understanding that millions of people are still operating on. If you collect Social Security before your full retirement age and you earn income from work, Social Security withholds $1 for every $2 you earn above the annual exempt amount. In 2026, that earnings limit was adjusted to $22,320 per year for people below full retirement age. Now that sounds like a reasonable buffer. But here's the trap that almost nobody talks about. The May 2026 policy update confirmed a stricter enforcement mechanism around misreported earnings, particularly for retirees doing gig work, freelance consulting, or contract-based income. The Social Security Administration has integrated new data sharing protocols with IRS systems, and they are now cross-referencing 1099 income in real time rather than on a 12-month lag. What that means is this. If you earned $28,000 last year doing part-time consulting and you are collecting Social Security at age 63, you just triggered a $2,940 benefit withholding. And unlike before, where you might get a grace period or catch it on your annual review, the new system flags it faster. The consequence of ignoring this is not just a withheld check. It can trigger an overpayment notice, which means Social Security starts recouping money from future checks, often at 10% per month, until the overpayment is recovered. I spoke to someone recently, a 64-year-old retired teacher who picked up some online tutoring work, who ended up with an overpayment notice for $4,200 because she did not realize her tutoring income had crossed the threshold. She was blindsided. The fix here is simple, but you have to do it before you earn the income, not after. Track your earned income in real time. Know your monthly cap. If you are close to the threshold, consider doing a voluntary suspension or adjusting your work schedule in the final quarter. And if you are already past full retirement age, the earnings limit disappears entirely, which gives you much more flexibility. Know exactly where you stand before you take on any new income source. Here is the third area, and this one has a psychological component that makes it especially dangerous. It involves Social Security taxation, and specifically a threshold that has not been adjusted for inflation in over 30 years. Here is the rule. If your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefit, exceeds $25,000 as a single filer or $32,000 as a married couple, up to 50% of your Social Security becomes taxable. If it exceeds $34,000 single or $44,000 married, up to 85% of your benefit is taxable. Those thresholds were set in 1983 and 1993. They have never been indexed for inflation. What that means in 2026 is that a massive number of middle-income retirees who would never have been considered high earners in the original spirit of this law are now being taxed on their Social Security at the 85% level. If you are a retired couple with a modest pension, some IRA withdrawals, and Social Security, you are almost certainly in this category. Here is a real example. A married couple, both retired, collects $38,000 combined in Social Security. They also take $20,000 a year from their traditional IRA for living expenses. Their combined income comes out to $77,000. Up to 85% of their Social Security, or $30,300, is now subject to federal income tax. At even a 22% marginal rate, that is over $7,000 in federal taxes just on their Social Security income. Most people sit down with TurboTax in April and feel blindsided by this. They thought Social Security was not taxable, or they knew it could be taxed but had no idea how much. The May 2026 changes did not fix this problem. There was significant political pressure to finally index those thresholds for inflation, and it did not happen. But what did change is that the IRS now has better integration with Social Security Administration records, which means underreported Social Security income is being caught faster. The actionable strategy here is called income management before you draw. If you have a traditional IRA and a Roth IRA, the sequence in which you take withdrawals dramatically affects how much of your Social Security gets taxed. Drawing from your Roth IRA instead of your traditional IRA reduces your adjusted gross income, which can keep you below the taxation thresholds. This is not a loophole. This is legal tax planning, and it is what wealthy retirees are doing with the help of advisors who cost them a few $100s a year to save them thousands. The fourth and final area is the one that financial experts are most urgently discussing right now, and it involves survivor benefits and spousal claim strategy in the post-May 2026 environment. When one spouse dies, the surviving spouse keeps the higher of the two Social Security benefits. That has not changed. But what has changed is how the Social Security Administration processes survivor claims following a series of administrative reforms that took effect this spring. The processing timeline for survivor benefit claims has been restructured, and several ancillary rules around spousal credits, particularly for widows and widowers who remarried before age 60, have been quietly tightened. Here is where this gets expensive. The average gap between a retiree's primary Social Security claim and the optimal claim strategy is estimated to be over $111,000 in lifetime benefits, according to research from the National Bureau of Economic Research. That number is not a typo. Most couples do not coordinate their claiming strategy. They both claim at 62 because the money seems like it is just sitting there, and they do not want to leave it on the table. But that thinking is exactly backwards. Every year you delay claiming Social Security past your full retirement age, which is 67 for most people born after 1960, your benefit grows by 8%. 8% guaranteed, risk-free, inflation-adjusted growth. There is no savings account, no CD, no bond in 2026 that gives you 8% guaranteed. If the higher earning spouse delays to 70 and the lower earning spouse claims earlier, and then the higher earner passes away, the survivor keeps that maximized delayed benefit for the rest of their life. This is the single most valuable financial planning decision most retirees never make deliberately. And the May 2026 administrative changes have added one more layer. Spousal benefit coordination forms have been updated, and filing errors on the new forms are causing processing delays of 60 to 90 days in some cases. That means if you are approaching a claim decision right now, you need to file early, file correctly, and ideally use the SSA's online portal rather than a phone call. The stakes are too high for a paperwork mistake to cost you months of benefits or lock you into a suboptimal claim choice. Let me leave you with this, because the bigger picture matters just as much as the tactical details. We are living in a moment where the retirement safety net is under more pressure than it has been in decades. The Social Security Trust Fund, under current projections, faces a potential benefit reduction of around 17 to 20% by the mid-2030s if no legislative action is taken. That is not a prediction designed to scare you. That is the math from the Social Security Trustees report. And what does that mean for you right now? It means that every dollar of optimization you do today, every smart claiming decision, every tax-efficient withdrawal, every earnings limit you track carefully, is not just about this year. It is about building a retirement income strategy that does not depend on Congress doing the right thing at exactly the right time. The people who understand the rules are going to protect themselves. The people who assume the system will take care of them are going to find out the hard way that it will not. You now know more about the May 2026 Social Security changes than most people who are currently drawing benefits. The question is what you do with that knowledge in the next 30 days. Run your numbers, check your earnings, review your claiming strategy. And if you are not sure where to start, the Social Security Administration's MIME Social Security portal at SSA.gov is free, it is accurate, and it will show you your projected benefit at every possible claiming age. Start there. This is your retirement. Nobody is going to fight for it harder than you.